Hello guys, today we are going to talk about pricing analysis again. So please remember, we have here three units. We have unit number 9, CVP analysis, which we have already covered. We have a unit number 10, marginal analysis, which is about decision making. This is already covered. And we are into unit number 11, pricing analysis. Please remember all these three chapters, unit 9, 10, and 11. This area is called decision analysis, and it is going to be your 15% of your exam. So in under unit number 11, so we have these topics. First topic is called 11.1, which is price elasticity of demand. We have already covered. 11.2 is about market structures, in which we have different types of market structures. So that is already covered. So today we are going to talk about 11.3, which is about pricing. So here we go. So here we go, guys. Pricing. First topic under pricing, we are going to discuss price setting factors. Like when we set the price usually for any product or any service, so usually which factors we need to consider. So first of all, the first factor is called cost of production. So cost of production means obviously, guys, when you produce the product, so usually you incur the cost of material, cost of labor, cost of variable overhead, and cost of fixed overhead in order to manufacture the product, right? So whenever we obviously set the price, we need to consider what is our total cost of the product. And then what we will do, we will usually add the profit margin into the cost. So once we will add the profit margin into the cost, this is how we will get the sale price. So this is what is called cost of production. So it is the main component of price. So obviously no company can sell its product or services at less than the cost of production, because if you would try to sell the product below the cost, so obviously you will make loss, right? So that is why whenever you are fixing the price, it is necessary to compile the data relating to the cost of production, and you should keep that in your mind while setting the price. So second factor we have here, which we need to consider while setting the price of the product or service, that is called what? Demand for the product. So guys, obviously we know whenever demand is relatively more than supply, like for example, there is a shortage of supply, but there is a more demand of the product. So in that scenario, so higher price can be fixed. Please also remember, you also need to consider a theory of demand effect on the price also, because as per theory of demand, so whenever you change the price of the product, it may affect the demand of the product also, right? So usually if your demand is elastic means if you will change the price with slight percentage, maybe there will be a drastic increase or decrease in the demand. So if your demand is highly elastic, okay, as compared to the price, so in that scenario, you should not charge high price. You should try to charge low price, because it will increase your demand. So this is also second factor which you need to consider while setting the price of the product. So we have your third factor, which is called price of competing firms. Obviously, let's assume the Pepsi company, if they want to set a price for their product, so what they need to consider, they need to consider the price of the competitors also. Okay, so for example, if Pepsi is trying to set a price for its product, so they need to consider the price of the Coca-Cola. Another example, for example, if Samsung is trying to set a price for its mobiles, so obviously they need to consider the price of the iPhone. So it is necessary to take into consideration the price of the product of the competing firms prior to fixing the price. Obviously, guys, so this is also important factor. So for example, in case of cutthroat competition, what it means, like when you have a a high competition level, so it is desirable to keep the price low at that time, because if you will try to charge higher prices as compared to your competitors, so you may lose the customers, right? So this is the third factor. So fourth factor which you need to consider, that is called purchasing power of the customer. Purchasing power, you can say simply, you should consider the income level of the people. If the people income level is high, so you may charge high prices. But if the income level of the people is less, okay, so then in that scenario you should charge less price. So this point you also need to consider, right? So if you don't know what is purchasing power means what are the purchasing power of a customers, and what price and how much they can purchase. Like simply you have to consider how much income they have, right? How much amount they have to spend. If they have more money, you can charge high prices. If they have less money, you should charge less prices. The fourth factor to consider while setting the price for the product. Then we have a factor number five, which is called government regulation. Sometimes, for example, I'm just giving example like for basic necessities, like for example, wheat, rice, these kind of things. So sometimes governments, they will fix the price of the product. And obviously, if you will try to sell your product above the government price, so it is considered as a violation of government laws and regulations. So they may impose fine on you. So that is why whenever you are setting a price of any product or any service, okay, or for any commodity, you should keep in your mind, so what is the price which is fixed by government, so you cannot charge more than that, right? So this is what is called government regulation. Then you also need to consider next factor, that is called your objective. So what is, you have to decide first what is your objective which you want to achieve, and according to that you have to set the price. For example, if your objective is to maximize the profit, so you may charge slightly higher prices to increase the margin, profit margin on your product. Or for example, if you want to capture more number of students, or if you want more number of customer, I mean to say, for example, if you want to increase the number of customer, so you may charge less price because you can get more customer, right? You also need to consider the product quality also while setting the price. If your product is having high quality, so you may charge high prices, because there is a justification to charge high prices because your product is differentiated, or your product is with the high quality. But if your product is having normal quality, and there are plenty of products are available in the market which are similar to your product, so then you should not charge higher prices than that. Otherwise, you will lose the customer. Then, guys, you also need to consider the types or type of the market, in which market you are operating. Maybe you are under perfect competition, or you are having monopoly or monopolistic competition, or you have oligopolistic competition, or maybe you have a monopoly. So, guys, you have to decide in which market you are. For example, if you have a monopoly mean to say, so you do not have any close substitutes of your product, right? At that time, you can charge slightly higher prices. Obviously, if you will charge extra high price, so maybe again the customer may, stop the usage of your product, and you may lose the customer. But you have to consider, for example, if you are under monopolistic competition where many suppliers are there, they are selling almost similar products, or maybe the products are very undifferentiated, are very close to each other's, or maybe products are close substitutes. In that scenario, guys, you should not charge high prices, because if you will charge high prices, maybe you will lose the customer. So these are usually the factors which you need to consider while setting the price of the product, and it is theoretical portion. So I hope so it is clear. Then, guys, we have here one note. So this is also small concept. So that is called price setting by cartels. What does mean by price setting by cartels? So here we have a definition. Cartels mean to say what? A cartel arises when a group of firms joins together for price fixing purpose. Like for example, there are 5, 6 suppliers are there. So like for example, in UAE we have Etisalat company, and we have a Do company. So they may join their hands to fix the price, right or wrong. So that is called price cartel. So usually this practice is illegal. So because if you have, let's assume 7, 8 key sellers in the market, and if they will join their hands to fix the price, so this is not good, right? So this practice usually is considered as illegal, but in international market sometimes it prevails. Okay, so please remember, here under price cartels, like price cartel, what is the concept? When group of firms joins together for price fixing purpose. So what will be the effect if they will fix the price? This is what I'm telling you the effect. So its effects are similar to those of monopoly. Obviously, if you will fix the price by joining hands of each other, so it means it's like a monopoly, so right? So here what each firm will restrict output, they will not supply more product, right or wrong. So they will restrict its output, they will restrict its supply, and they will charge a high prices and earn the maximum profit. So this is what is called price setting by cartels. But you should remember here the definition. What is the definition of uh, price setting by cartels? Then we have, guys, here we have some uh, general pricing approaches we have. So there are different approaches which we can follow to fix a price. So the first approach for pricing is called new product pricing. New product pricing means if you are going to launch a new product, okay, into existing market or into new market, so you may follow two strategies. So one is called price skimming and second is called price penetration. So what does mean by price skimming? It means when you launch the product, so usually we will charge high price at introductory stage. Introductory stage means whenever you will launch the product, so it means we will charge at that time high price. Like for example, iPhone, Apple, if you have noticed that, so whenever they launch their new model of a mobile phone, a new generation, so what they do, they usually charge high prices. So the reason is that, mainly reason is what? Because they want to recover their research and development cost, which they have already spent on the manufacturing of this product. So this is what is called price skimming. So remember, skimming means a at introductory stage. So the introductory price will be higher to attract buyers. Understood? And usually, obviously, iPhone user, they are not concerned about the price, right? They are ready to pay the price. But the objective of the company is to recover research and development cost. This is what is called price skimming. But on the other hand, we have totally opposite strategy. So that is called price penetration. So what is price penetration? So here what you will do, you will set the introductory price relatively low, like at initial stage when you launch your product. So you may set the price low. Why you are setting the price low? Because you want to gain the market share, or maybe you want to gain the deep market penetration quickly. What it means, you want to attract more number of customers. So this is what is called penetration. So the keyword under price skimming is here the introductory price will be higher. Okay. But the keyword for the price penetration is here the introductory price will be lower. Understood? And here our objective is to recover research and development cost. And here our objective is to gain penetration into the market quickly or to attract more number of customers. So this is what is called price skimming or price penetration. So this is what is the first approach, which is called new product pricing. For new product pricing, you have a two kind of concepts: price skimming and price penetration. Now we have another approach that is called, guys, what? Competition based pricing. So please remember, competition based pricing it includes one it is called going rate pricing, and second it called sealed bid pricing. So please remember what is the difference between a going rate pricing or sealed bid. If you will just look at here, so going rate means say you are going to charge the price which are prevailing in the market. And for example, if you are selling a commodity, let's assume, just giving example, let's assume you are selling rice or wheat. So you have to look what is the price in the market. So the same price you can charge. You cannot charge more price than market, right? This is what is called going rate. So going rate, you can also assume it is like a market-based pricing, right or wrong? And sometime, for example, market, because you need here what is prevailing in the market, right? For the going rate. Sometime if in the market price is not available, how you can find? So you have to look actually the leader in the market. For example, sometime market price is set by government, like in case of commodity. But if it is not a commodity, if it is other product, you have to look who is the leader in your market, who is the largest player in the market, who is the big company in the market, and check how much they are charging, right or wrong. And according to that, you can adjust the price of your product, right or wrong. This is what is called going rate, like what is prevailing in the market. So it's also called market based price. Understood? Then we have here sealed bid pricing. So I can just give you example for the sealed bid pricing. So what it means, so let's assume the government, let's assume the your country's government, they want to construct a road from, let's assume from the city, one city, let's assume city A to the city B. Okay, let's assume this is what is their this is what is their project for the government. They want to construct a road. Now they're asking different contractors, different construction companies to bid for it, like how much they will charge to construct this road. For example, there is a company, ABC Limited, let's assume. So they bid for it. It's sealed bid. It's not open. Okay, it is not like an auction. It is bid under sealed envelope. For example, they are saying they will charge $1 billion. Okay, there is another company, let's assume XYZ. So they bid it, they bid under seal, for example, seal bid. So they bid the price, let's assume $0.85 billion. Okay, let's assume, I'm just giving example. Now, obviously, all contractors or all construction companies, they will bid the price, and later on the government will select which company is the better, depending upon the quality and the price, right? So this is what is called sealed bid pricing. So sealed bid pricing basis pricing basis price on a company's perception of its competitors price. Obviously, this what it means. It means here XYZ company will think how much ABC has charged, and XY will also consider his cost, like how much cost is there and how much profit they can charge, what should be the minimum price, and then they will bid for it, right? This is called sealed bid pricing. So you can go through sealed bid pricing is written also here. So sealed bid pricing is the process of offering to buy or sell products at price designated in the sealed bids. Understood? Companies must submit their bids by a certain time. Obviously, all contractor companies, they will submit their bids, understood, within the required time, and then bids are later reviewed at all once. Maybe later on, the government will review the bid, okay, or the different bids. So, and the most desirable one is chosen. Obviously, if government feels that ABC company's bid is better or XYZ is better in terms of quality and cost and price, so they will select that one. So sealed bids can occur on either the supplier or the buyer side. Maybe you want to provide your services. This if you are bidding, it means it is like a supplier side. Or for example, if you want to buy something and you are quoting a price, that is like a buyer side. Understood? So it can be from supplier or buyer side both. So this is the second category we have already discussed. Second category is called competition based pricing. So we have discussed first new product pricing, in which we discussed product uh, skimming, price skimming, and price penetration. Then we have a competition based pricing, which is called going rate and sale bid pricing. And then we have here another thing that is called what? Uh, market based pricing. Market based pricing or buyer based pricing. So market based pricing. So here is a definition. For example, what is market based? It is like a going rate, as I told you. Going rate, like whatever the rate is prevailing in the market. So market based pricing is typical when there are many competitors and the product is undifferentiated, like as it's happening in the commodity markets. Like for example, there are many buyer or sellers. They want to buy or sell wheat, rice. Okay. So for example, if there are many sellers, in case of commodity market, so at that time, so you have to charge only the price which is prevailing in the market. And in that scenario, in terms of commodities, most of the time market value is set by the government, so you cannot charge more than that. This is what is called market based, like what is the price which is prevailing in the market, that is called market based pricing. Understood? Then we have here one more concept that is called product mix pricing. So there are two words are there, guys. One is called product mix and second word is called a product line. So let me explain first what is the product line, then we will come back to the product mix, and then we will see the strategies. Product mix pricing, how what is the product mix pricing. So here we go. First of all, we are talking about product line definition. I'm going to explain what is the definition of product line. Product line is a group of related products targeting the same customers. Okay, and usually it is within the company. So let me give example. For example, so it is a group of related product. Group of related product is called product line. For example, Coca-Cola. Coca-Cola companies, they have three main product lines. So they have sodas, Minute Maid, and then they have a mineral water. Under sodas, which we call it soft drink. So under sodas, so they have five products like Coca-Cola, Diet Coke, Coke Zero, Fanta, and Sprite. So like under soda, so this is the product line. So they have five products inside. Under Minute Maid, they have three products. Three products under Minute Maid. Which three products? So they have guava juices, mango, and mixed fruit. And then for the mineral water, which is your third line, there is a one product which is mineral water. So it means all these sodas, Minute Maid, and mineral water. Even under sodas, we have a different types, right or wrong? So these are three main product line of the product. So this is what is called product line. Product line is what? Is the group of related product. So in this example, so Coca-Cola is having three product line. Now, what is the product mix? Product mix, I'm going to explain now. So product mix is what? It is the total of all product lines. Total of, so there are three product lines are there under Coca-Cola brand. So total of all product line within the company. Company is what? Coca-Cola. So within the Coca-Cola, so there are three product lines. So those three product lines are called what? Product mix, because they can mix these products right or wrong, and then they can sell the product. Right. So this is what is called product mix. So what is product line? It is a group of related product. And what is product mix? It is total of all product lines within a company. So that is called product mix. So now guys, here we are going to talk about strategies, pricing strategies. So here first, please, we have a first strategy, which is called product line strategy. Need concentration. So this is what we are talking about, product mix pricing. Okay. Don't forget our heading. So this is third time we are discussing product mix pricing. So under product mix, I have explained first what is the product mix, what is the product line. So now I'm going to explain what is the product line pricing. So do you remember under sodas, we have different products. We have Coke, Diet Coke, Zero, Coca-Cola. We have, for example, Fanta, we have a Sprite. So all these are called a product line. So what we can do now, so what is product line pricing? So product line pricing means it often involve what? Adding or removing items from the certain product. For example, you're making combination of Coca-Cola plus Diet, or you're making combination of Coca-Cola plus Sprite, or maybe you're making combination of Coca-Cola plus, for example, Fanta. So this is what is product line. So you can, it may involve adding or removing items from a certain product line. This, like, why you are making this? Because this allows the company to attract more buyers or enter into new market. So for example, let's say if you want to buy a Coca-Cola, maybe I like Coca-Cola, but with Coca-Cola, let's assume Diet is free, so maybe I will buy this one. Maybe I like Sprite, with Sprite Coca-Cola is free, maybe I'll buy this one. So this is how you can increase your sale. So this is what is called product line pricing. So product line pricing means that you will make a combination of the product and then you can sell it. This is what is called product line. So in the product line, you can add or remove items from certain product. Understood? Then we have here optional product pricing. Optional product is what? I can just give you example. For example, when you buy a smartphone, right or wrong? So with the smartphone, so you may have a mobile case also, right or wrong? So because why? So the mobile, if you will use the mobile case, maybe it can enhance or it can increase the durability of your product. But still, if you don't have a case, but still mobile can be used without case. So right. So what is optional product pricing? Now, optional product pricing requires the firm to choose which products to offer as accessories. Maybe accessories could be case or hand free with mobile, and which standard features of the main product, like which you will make a combination again, like main product with the main product. You will add accessories. If the customer will buy only main product, maybe the price is different. Maybe if they are buying with accessories, maybe customer will get slight discount and he will prefer to buy that one, right? That is called what? Optional product pricing. Optional product pricing means, say there is the main product, which product you want to keep it as optional with the main product and then set the price. This is called what? Optional product pricing. Then we have here a captive product pricing. Captive is what? Like it is very practical example. Like if you buy, a razor, uh, Gillette razor, let's assume. So maybe Gillette razor is cheaper one. There are certain Gillette razors are available in the market, for which the blades can be replaced, right or wrong. So what is the captive product pricing now? So here, so they are saying captive product pricing involves product that must be used within the main product. Obviously, with the razor handles, guys, with razor handles, so companies are selling blades separately, right? So initially, you will buy a razor plus one blade, which is attached with the razor, and obviously, maybe you are paying $2, $3, but later on, you can buy the only blades and replace the existing blades. But the blades, additional blades, which you will buy later, so that is called captive product. And obviously, so what the companies do, what the Gillette company is doing, so initially they are selling initial one blade with one razor, like complete razor. Maybe they are selling cheaper. But if you will buy the blades later only blades if you will buy to replace the old blade, so maybe they are charging high prices for that. That is called what? Captive product pricing. So captive product pricing involves that must be used within the main product. Okay, such as razor blades with the razors. Often the main product is relatively cheap, as I told you, the razors initially it will be cheaper, but the captive products, which are the blades, have high markups later on. So this is what is called captive product pricing. It is very, you can say, another strategy, third strategy. Then we have, it is and very close to the previous one, right? So now we are talking about byproduct pricing. Byproduct is what? I'm just giving you one example. For example, you are having a garments factory. You are maybe stitching shirts, pants, like that. And obviously, when you stitch, uh, or when you cut the fabric to stitch the garments, jackets, pants, like that, so obviously you have some leftover from the production. Okay, like leftover is what? Small pieces of the fabric. So what you have to do now? So this is the leftovers from the production is called a byproduct for you. So the byproduct, what you will do, obviously, this leftover, maybe you will trash somewhere, you will throw somewhere, you will dump somewhere, or maybe you will store it, right or wrong. If you will store it, so you have to incur the cost. So what we do usually, maybe we can sell this leftover to another company which is making pillows, like that. Okay, so they can use these leftovers, understood, to make pillows, etc., to make toys. So byproduct pricing mean to say, so when you sell the leftover, how much you should charge? At least you should charge. So whatever you have incurred to store or deliver the byproduct to the new customer, so you should charge more than that. For example, to store this leftover, I spent $5, and to store this leftover, I paid $1 to deliver. For example, total my cost is six. So if my buyer is ready to pay more than $6, I should sell it. This is what is called byproduct pricing. Then, guys, we have a product bundle pricing, because again, it's a mix of the product. Like for example, when you go to the market, you may have a body spray plus perfume. Right or wrong, this is one combination. Right or wrong, if you will buy a body spray separately, maybe you will pay $5. If you'll perfume, maybe perfume, if you will buy perfume, maybe you will pay $20. So total cost individual for individual item is 25 for individual. Like if you will buy body spray separate, perfume separate, so you would pay 25 in total. But what companies they can do? They can make a bundle now. They can make a bundle. They can make one package in which one perfume is there, one body spray is there, and they can charge a price of $22, and you would happily buy it, right? If you will buy separately, you would pay 25. But if you will buy as a package, you will pay only 22. So obviously you will buy. So most of the customers having this habit, because when they see a lot of things are in offer in the supermarkets, they buy it, right? This is what is called product bundle pricing. Now, guys, we are talking about illegal pricing. Illegal pricing. First, I told you one thing, that is price setting by cartels. When where few suppliers will join their hands together to fix a price. That is also illegal. Please also remember, this is predatory pricing is also illegal. What is predatory pricing? Like sometime, maybe as a supplier, you are ready to sell your product below the cost. You are ready to sell your product below the cost. Why you are ready to sell? Why you are ready to take losses? The reason is that maybe you want to destroy the competitors. So this is called predatory pricing. Predatory pricing means, say, when we sell the product below the cost, right or wrong, even you are not recovering your cost of the product. That is called predatory pricing, and it is also illegal, right? So this is what they are saying, that because there are certain cases. Okay, so sometimes it is also called dumping, product dumping, predatory pricing. Okay, so this is also not allowed. But I'm not saying in all market it depends. Actually, please remember, you should remember the word predatory pricing. Predatory pricing is what? When you sell your product below the cost. Okay, and your objective is to destroy competitors. Okay, and this is usually is considered as illegal pricing. So this is what is called predatory pricing. Then guys, here we have here what? Cost-based pricing. This is another strategy. So cost-based strategy, for example, here you have to look first what is your cost of the product. That is the main thing, right or wrong? And if you know your cost of the product, in that you will add the profit margin. This is how you will get the sale price. So this is called what? Cost-based pricing. Like, so you should look what is your cost of the product and how much return you want to earn on your cost, and then you will take cost plus profit. This will give you sale price. Now the point is that here cost mean to say what? Like for example, where the products are differentiated, like in automobile industry. So what will happen? They will not follow only cost based pricing. They always follow the combination of cost based and market based pricing. Like obviously they will consider what is their cost, right? They want to charge more than that, and but they also need to consider so how much your competitor is charging for the similar product. So mostly automobile sectors, they will focus on cost and market based pricing. Both they will combine it. But for example, if you are manufacturing any product which is made to order, for example, Rolls Royce, maybe they are manufacturing a car on your order. So in that scenario, they may follow cost based pricing. So they may check first what is the cost to prepare this car, and then they can add a profit into that, and then they can get the sale price. Actually, it depends. Sometimes you need to follow cost based and market based pricing approaches. You need to combine it, or sometimes you can follow only cost based. And as I told you, cost based pricing is best if you are working on made to order. Understood? This is what is called cost based pricing. Please also remember, so markup pricing is what? For example, if you know your cost and you want to add profit, for example, 5% profit, but 5% profit on 5% profit of cost. So this profit will become your markup now. Markup is what? So in markup pricing, so also called cost plus pricing. Markup pricing means a cost plus, like cost plus profit equals your sale price. So for example, if you, let's say you want to add 10% profit, okay, so what you will do, you will apply this 10% on your cost. So this is called what? Cost plus pricing or markup pricing. Now because this 10% is of cost, so this profit is called markup, right? Markup. Now please remember, this is general equation. We always consider what? Cost. We need to take the cost of the product, plus we will add profit, because under markup, what you do, you take profit of cost, right? For example, cost is $100. You want to take 10% profit. 10% of 100, it will give you $10. So this is how you will get sale price of 110. Now the point is that cost, which cost we have to consider. So there are different formulas are there for cost plus pricing. Please remember, let me tell you first simple concept. If company is using, if company want to take only here variable cost mean to say variable manufacturing cost. So where variable manufacturing means, usually it includes cost of material, cost of labor, and cost of variable overhead. Okay, so if you will add these three costs, this is called variable manufacturing cost. So then what you will do, you have to add profit. Add profit. Variable manufacturing cost multiplied by markup percentage. For example, markup percentage is 10%. Actually, you are taking 10% off cost. So this will give you profit value. This profit you will add along with the variable cost. This will give you price. Understood? And for example, if company is using absorption costing, in absorption costing, usually a product includes what cost of material, cost of labor, cost of variable overhead, and cost of fixed production overhead. So this is called absorption cost. Understood? So if you are taking absorption cost, so you have to take first absorption manufacturing cost, which includes material cost, labor cost, variable overhead cost, fixed overhead cost. Okay, add all these. This is called absorption cost. Then plus you have to add profit. You will take markup percentage, multiply with this absorption manufacturing cost. If you will obviously, let's assume your absorption manufacturing cost is $100. I'll take 100 plus 100 absorption manufacturing cost. Let's say profit you want to take 10%. So if I'll multiply 10% with 100, it will give you profit side $10. $10 I'll add with the absorption manufacturing cost. So this will give you price. So then some companies, they consider, as I told you, some companies, they consider only variable manufacturing cost, then they add profit, they get sale price. Some companies, they consider only absorption manufacturing cost, then they add profit of this cost. Understood? They will get sale price. And some companies, they take total cost. Like for example, if you are following life cycle costing, so you should consider life cycle costing means say what cost you will incur throughout the life cycle of the product, through the introductory stage till the product retirement. For example, it may include research and development cost, production cost, distribution cost, marketing cost, all the cost. Okay, you have to consider first, and then you can estimate what is the cost of one unit. So then take that total cost, multiply by total cost, multiply by markup percentage. So if you will again multiply total cost with the markup percentage, this will give you profit of total cost. Then this profit you will add with the total cost. This will give you price. And some companies, they consider what? Total variable cost. Total variable cost as a cost. Total variable cost means say it includes cost of material, cost of labor, cost of variable overhead. So all these are manufacturing, but it may include non-manufacturing variable cost, like maybe a selling cost, marketing cost, whatever non-manufacturing you have. But you have to take total variable cost. Okay. Some companies, they take total variable cost and then they add profit into total variable cost. So this is also called cost plus pricing. For example, total variable cost plus total variable cost multiplied by markup percentage. This will give you again profit. And this profit you will add with the total variable cost. This is how you will get the price. So this is what is the point here. Point is like which cost you have to use. Some companies, they use total cost and then add profit. Some companies, they use absorption manufacturing cost, then they add profit. And some companies, they use variable manufacturing cost, then they add profit. And some companies, they use total variable cost and then they add profit. This is what is called cost based pricing. So here we have a small example. Maybe this example is for actually absorption pricing, like absorption cost. Okay. So for example, let's assume we have a 4 dies cost were as follow. We have a direct material of $12. This is per unit cost. We have a direct labor of $5. We have a variable overhead of $3. And we have a variable selling cost per unit is $1. This is variable overhead production cost. This is selling means a non-production. Okay, so please remember here, then they told you if you're using absorption manufacturing cost, so then it is irrelevant. This cost is not relevant because it is selling cost. Then only production cost you have to consider. All variable plus fixed cost you need to consider. So here we will take material cost, labor cost, and variable overhead production cost. And then we need to add fixed cost. So fixed overhead cost for the year total how much? 200,000. And fixed selling and administration cost for the year is total 100. This is not relevant because it is non-production. Only production cost you have to take, like production, material cost, labor cost, variable overhead, plus fixed overhead, all production cost. Don't take non-production to get the absorption cost. So here we have here what? A fixed overhead cost for the year total is 200,000. This fixed selling and administration cost for the year is 100,000. This is irrelevant. So then during the year, 4 dies produced 1,000 units and sold 90,000. Whatever units you have sold, this is irrelevant to calculate the fixed cost, because under absorption costing, you calculate a fixed cost per unit if you want to calculate. So you have to take fixed production cost, which is 200,000 divided by unit produced, which are 100,000 given here. Unit produced, not sold. Understood? So this will give you $2 per unit. So now tell me, what is the manufacturing absorption cost? Absorption cost, it will include cost of material 12, we'll take 12 plus variable labor cost 5, we'll add 5. We have variable overhead 3. Okay, then we have a $2 of fixed cost. This is how 22 per each unit. Understood? So obviously, if guys, this is your absorption cost. Let's assume if you want to take a 20% of your profit, let's assume if your market percentage is 20%, so how would be your price? So price should be equal to absorption cost plus absorption cost multiplied by markup percentage. So absorption cost is $22. We calculated here. Now plus $22 into 20%. If you will take $22 into 20%, so I hope so it is going to be 4.40 something. Understood? So if you will add now this absorption cost plus this profit, so 26.40 is going to be your price of the product. Understood? So this is what guys, cost-based pricing. Now we have here usually another thing. Let me tell you here, target pricing. What is the concept of target pricing? This is another way to get the target cost or target pricing. So let me explain here, guys. For example, sometime let's assume if you have a perfect competition, so maybe you do not have control over pricing. You cannot increase prices. In that scenario, what you have to do, guys? So you always take the market price. Like what is the market price? Okay, if from the market price, if I deduct my profit margin, okay, this will give you my target cost. So let me give you example first here. For example, usually question is what? Question is what? Cost plus profit is equal to sale price. Nowadays, we do not have control over the sale price. You cannot increase depending upon your cost. So you cannot manage sale price. You have to manage only cost of the product. So now if you want to know, for example, if in the market price is $20 for the product and you want to earn profit of, let's assume, $5, right? So then it means your product should have a cost of $15, right? This is what is applied here. So market price is 20 minus profit is 5. So target cost is what? $15. So your product cost should be $15. You should complete your product within this $15, because if you will complete your product within $15, so then you can earn $5 profit, because you cannot sell more than $20, right or wrong? So sometime what's happening, this is called target cost. Target cost means that this is the cost in which your product should be completed. Sometime what may happen, your actual cost maybe let's say $18, but your target was $15. It means how much extra you are paying? $3. $3 extra cost you are incurring. So what will happen if, for example, your actual cost is 18? So what will happen, guys? So 18 is your actual cost, and you cannot sell more than 20. It means your profit will reduce automatically, right? Your profit will reduce automatically to $2. Right or wrong? From 5 to 2. So it means sometime what happening, your actual cost could be more than target. If your actual cost is more than target, actually your profit will reduce. Profit will reduce because you cannot charge more than market price. So that is why we need to manage our cost here. So this is called cost gap. Gap is what? Target cost was 15. You should have completed your product within $15, but actually you are consuming $18 to complete the product. It means there is a gap of $3. This gap you need to bridge now. How you will bridge? Maybe you need to do some value engineering of the product. What is value engineering? I'm explaining. So you need to identify which are value adding cost, which are non-value adding cost. Value adding cost means which has value to the customer. Non-value adding cost means which doesn't have any value to the customer, right? So what you have to do, you have to identify, you need to do value engineering. What do you need to do? Value engineering. Value engineering means that first you need to understand which cost are value adding and which cost are non-value adding. So non-value adding cost can be cutted. For example, packing cost. Customer don't care how your product is packed. Customer, like, let's say you are selling mobile phone. Okay, if mobile phone is even for $2,000, but customer will look only with the only to the main product, not to the packing, how it is packed, right? So that is what packing is non-value adding cost. You can reduce it. So this is how you can bridge the gap between actual cost and the target cost. So this is what is called target pricing or target cost, right? Then guys, this is what is written here, like target cost, how you got market price minus desired profit. So this is the your target cost in which your product should have been completed, right? And I told you value engineering concepts also you can go through. I told you what is value engineering. Like in when you do value engineering, you want to cut the cost, right or wrong? The reason is that if your product is taking $18 in actuality, but you need to complete in $15, so there is a gap of $3. This $3 you need to cut. So you should look at R&D stage. You should look at product design stage also where cost can be cutted. In manufacturing, how cost can be cutted. In marketing and distribution, maybe how cost can be cutted. In customer service, how it can be cutted. So you have to look how you can reduce this $3 per unit. That for that I told you have to know what is your value added cost, what is your non-value added cost. This is what you have to go through, guys. Now, guys, apart from this, we have some other. Now, this is another topic which is called price adjustments. Okay. So, what is the price adjustment? So here we go. Here we have a small again. Few concepts are there. Please go through. Let's have a look. So first of all, we have a price adjustment is what? So one, this is geographical pricing we are talking about. Like you're adjusting price according to the geographical area. For example, let's assume you are selling the products from Dubai. Okay, you are maybe selling products online. So what is first FOB origin pricing? This is what I'm going to explain. FOB origin pricing is what here as a seller you will charge each customer its actual freight cost. Obviously, you will charge the price of the product plus you will charge also freight cost. Freight cost means say like shipment cost. And what cost you are checking this freight cost or shipment cost, which is actual freight cost that you are charging. For example, if you're dispatching goods from Dubai to India, price could be different. Actual price could be different. If you're dispatching goods from UAE to Europe, price could be different. Okay, this is what is called FOB region pricing. Like here, each customer, you will charge actual freight cost. Then you have here another thing, which is called uniform delivered pricing. It is another thing. Uniform delivered pricing, as per the word, it means like you are charging same price to all customers, regardless of their location. For example, you are charging, let's assume, $150 in total, even you're dispatching goods to India, to Europe, to USA, wherever. Understood? So this is what is called uniform delivered pricing. And obviously, if you're following same pricing strategy, it is easy to administer. Okay, obviously, so you can advertise your product over the internet even throughout the world. Then we have a zone pricing. This is very simple example. Like mostly we use, for example, metro, train for the traveling purpose. Let's assume in Dubai. So they have divided the areas into zone. For example, this is zone one. Under zone one, there are 6 metro stations are there. This is zone two. There are, let's do more 6 metro stations. Zone three, more 6 metro stations. Like if you are traveling within one zone, for example, from this metro maybe to this metro station, they will charge only 3 dirham, right? But if you're charging from zone one to second zone, maybe they will add 2 dirham extra, so they will charge 5 dirham. So if you maybe you are boarding the bus from this zone, you are going to maybe, for example, leave the bus at the third zone, maybe they will charge, let's assume, 7 dirham. Okay, so this is what is called zone pricing. Zone pricing what? So zone pricing sets differential freight charges for customers on the basis of their location. Okay, here customers are not charged actual average freight cost. No, it is charged based on zone. For example, another example, let's assume delivery charges. So if you are dispatching to Europe, any product, maybe it is to Italy or to France, to Germany, so regardless whatever country it is, so maybe you will charge same price. Okay, but if it is to, let's assume, to Asia, Asian countries, maybe the price could be different. This is what is called zone pricing. Then we have here we have here basing a point pricing. What is basing point? Let me tell you. For example, you are manufacturing product in USA. This year you are doing manufacturing of the product, but you have main warehouse in Dubai. Okay, and from here you are selling the goods to the customer. Here you have a warehouse. Let's assume here you have a warehouse. So now what? So obviously, as a USA manufacturer, you will first dispatch goods to Dubai. You want to store in your warehouse, and then you are selling to different countries. And now when you are charging freight charges, so they don't include this freight charges from the main origin or from the origin of the product to the Dubai. They will always calculate the freight charges from this place to onward. So if this is the scenario, this is what is called basing point pricing. So if you will go through this, what's it's written, basing points pricing charges each customers the freight cost incurred from specified city. Specified city is what here in my example, Dubai. From Dubai to onward, they will charge cost. So, okay, to the destination, regardless the actual point of origin. The actual origin point was USA. Okay, so from USA, you are sending goods to Dubai, and from Dubai, then you are selling to the different parts of the world. So what they will charge price or freight charges from Dubai to onward. Understood? This is called basis point pricing, and then you have some pricing which is called like discounts and allowances. You know it, guys. For example, there is a cash discount. Cash discount. There are sometimes offers are there like normally the list price of the product is $50, but now there is offer you can buy the same product by paying $30. Okay, so the cash discount encourage prompt payment, improves cash flow, because obviously if you will give a discount of $20 here because you're offering at 30 now, so obviously people will buy, so you will get more cash flows, and obviously people will buy by cash, so there is less chances for bad debts also. This is what is called cash discount. Cash discount means it is the reduction in the list price of the product. Then, guys, you have here like a quantity discount. Quantity discount, it encourages large volume of purchase. For example, we are saying that, let's assume, I'm just giving example. So, for example, we are saying that if you will buy one shirt, so price is $30. But if you will buy two shirts, price is $40. Let's see, for 240. So obviously people will buy two shirts now, right? This is what is called quantity discount. So obviously here we are trying to encourage our customers to buy more units from us. Then we have here a trade discount or functional discount. Sorry, I have made mistake here, guys. Under cash, this is cash discount is different, and trade discount is different. Cash discount means say, like for example, when you sell goods on credit. Sorry, my mistake. Maybe I mixed it. So when you sell goods on credit, right or wrong? For example, you sold the goods on credit for 30 days, but maybe you need cash after 10 days. What you can do, you can offer some discount. Discount of what? Like for example, if customer would pay within 10 days, you may give them a 3% discount. Understood? 3% discount. Okay, for example, if invoice value was $100, so customer will pay you only $97. But if they will pay within 10 days, so this is what is called, it will encourage prompt payment. It will improve your cash flow because you're collecting cash earlier and you can avoid bad debts. Now, this is the trade discount. What is trade discount? It is the reduction in the list price. Sorry, guys, it is mixed up. It is the reduction in the list price. As I give you example, for example, shirt price is $50. Now you're giving discount of $20, right or wrong, and you are offering the shirt at $30, right? So this is actually the $20 discount, which is discount in the list price. That is called what? Trade discount. Okay, guys, so this is what is called trade discount, functional discount. Then we have a sometimes seasonal discount. This, like seasonal discounts are offered for sale out of season. For example, if winter season is going to end, so maybe you may have a sales on winter season's garments, right? So this is what is the simple things. You have to just go through, please. Then we have a psychological pricing. Psychological pricing is what? Obviously, guys, we will charge the price to the customer based on his psychology, right? For example, if I feel that customer is rich, he has no information about the product quality. Okay, he has no information, and I know he can pay even the bigger amount. So maybe I will play with your psychology and I will sell the product at high prices. But if I know you have a complete knowledge of the product, you know the quality of the product, at that scenario obviously cannot play with you, so I will charge normal price. This is what is called psychological pricing. Psychological pricing, which is based on consumer psychology, right? For example, consumers who cannot judge quality may assume high price correlate with the high quality. He may think, oh, high price means a product is having good quality, so he will pay if he doesn't have any information. Then sometimes we have a promotional pricing. A promotional pricing is what? So which temporarily reduce prices below the list or even cost to stimulate sale. Like obviously when you promote the product, maybe you are ready to sell at below the cost of the product, which is technically illegal if you are into specific market, but it depends country to country, right? But if you're ready to absorb losses, maybe you can do it. Then we have a value pricing. Value pricing means say what you have to think like, what is the value of this product to the customer? If customer is giving high value to this product, maybe it is fit for use, maybe you can charge high prices. But if you feel this product is not having value to the customer, okay, maybe you can charge low prices. Then you have a international pricing. International pricing means say they always adjust pricing to the local conditions. For example, KFC, one burger may have different price in USA, same burger may have different price in India or another country. This is what is called international pricing, where they adjust the price to the local conditions. Understood, guys? This is what you have to go through. And now I'm going to show you some questions. You can just go through the questions, guys. For example, an entity has developed and patented a new laser disc. So, like they have developed the laser disc and they got the patent for it, and that will be marketed internationally. They want to sell this disk internationally. Which of the following factors should the entity consider in pricing the device? Like they're asking which factor you should consider while setting the price of this device internationally. So you should consider quality of the new device. Sure. You should check what is the quality of this product, right? If quality is high quality, you may charge high prices. If low quality, you may charge low price. Life of the new device, yes, you should consider how many years it can last. If it can last for many years, you can charge high prices. If it has very short life, you may charge less price. This factor is also relevant. Then customers' relative preference for quality compared with price. Yes, you need to also consider quality compared with price also, like customers are ready, what amount they are ready to pay for this type of quality. So this factor you also need to consider, right? So then you should set the price. It means you should consider all these factors. All these factors are important, so which should be the correct option? B, 1, 2 and 3. All factors must be considered. Now we have here another question, guys. For example, let me show you this question. They're saying an entity is planning to introduce a new product. So they're planning to introduce new product, DMA. It is expected that 10,000 units of DMA will be sold. So they can sell 10,000 units. The full product cost per the full cost. Full product cost per unit is $300. It includes all costs. Invested capital for this product is 20 million. This is what amount they have invested in to manufacture this product. The entity's target rate of return on investment is 20%. So what is the company's target? They want to earn 20% return at least on their investment. So it means what return they want. If you want to calculate return, you need to know what is the value of investment multiplied by 20%. Investment value is 20 million. And if you will take 20%, so this will give you return 4 million. Understood? Fifth portion, right? 4 million. This is what they want to earn. Then they're saying the entity's target rate of return on investment is 20%. The markup percentage for this product based on operating income as percentage of full product cost will be. They're asking what is the markup percentage. So markup percentage, how you will calculate markup on cost. So first you need to know what is the cost. This was the return, guys. One thing. Now you need to know what is the cost of the product, total cost, because here we calculate total return. So total cost is how much? Because 10,000 units they are manufacturing. Each unit is having cost of how much? 300. So I guess it will give you 3 million if I'm not wrong. Just check how much it is. So 10,000 multiplied by 300, it will give you $3 million. So this is going to be cost. Now you want to calculate markup percentage. Markup percentage, how it will be calculated? You have to keep return as a numerator, cost as a denominator, and multiply by 100. Because you want to see how much is the return in percentage of cost. Return is what 4 million we want, and cost is what 3 million, and multiply by 100. So I guess it is going to give you 133.3% as markup percentage. Understood, guys? I hope it is clear. And then we have here another question. For example, they are saying that which of the following is the least relevant factor to consider when determining the target cost for a new product. Target cost, you know, right? Market price minus profit is equal to target cost, right? So they're saying which is the least relevant factor. So the desired profit that the company wants to earn, yes, it is relevant. It is not least. It is very important. It's a part of formula. The market price of the competitive product, yes, it is also relevant. It is not least. It is very important to arrive at target cost. A possible new manufacturing technologies that can achieve higher productivity. Yes, you should consider. This one also, because new technologies can help you to meet this target cost, right? It is also relevant, right? Then selling price of existing product, this is not relevant. Like what you are charging for your existing product, that is not relevant. So what you are going to sell now, what is the market value of that, that is relevant. How much profit you want to earn, that is relevant. Okay, which technologies you will use to achieve this target cost, that is relevant. So selling price of existing product is not relevant. Okay, guys, so this is how questions would be tested. I hope it is clear, guys. So rest you can do, you can complete the questions. I hope so it is clear. If you have any question, you can ask me, please.